Hi, good afternoon. Thank you so much for joining us this afternoon. My name is Ala McCoy. I am Director of Startup Support at UM Ventures at the University of Maryland. And I'm very happy to welcome today Tolu Oleru to teach us all we need to know about startup relationships with banks. So Tolu is an experienced banking professional who works with startups. She is a vice president in Pacific Western Bank's venture banking group, and she manages the bank's portfolio of loans to tech startups in the Mid-Atlantic area. Tolu holds a BS in accounting from University of Pittsburgh and an MBA from Duke University, which we will not hold against her because she did grow up in College Park. So welcome, Tolu. Thank you so much for spending your time and your knowledge with us. But before we begin, I would like to ask everyone to please submit your questions. As Tolu is talking to us, please submit your questions via the Q&A function at the bottom of your screen. And Tolu will address those questions at the end of the presentations, but please keep submitting them as they come up. So again, thank you so much for joining us today. And you can take the mic.
Got it. Well, thank you so much, Ala. I appreciate you giving me the opportunity to speak to some folks in the University of Maryland system. And yeah, I'm a native. I still live 2 miles from the University of Maryland. So super excited to be able to do some work in the community. So I will be sharing my screen now. And Ala, can you confirm that you see the presentation? Perfect.
Yeah,
okay.
Yeah, we can see. Thank you.
Great. So today we're just going to be focusing on a couple of key things. One, how do you open a deposit account for your business? And secondly, which is going to be the meat of the presentation really, is business credit. So loans, revolving lines of credit, credit cards. We're going to touch on all of that stuff. So this is me, my photo. Here's a little different now. And this is my contact information. And I invite anyone who's watching or listening to reach out to me if you have any questions whatsoever. I'm more than happy to be a resource as you sort of think about starting your business and the banking related to doing that. I'm just skip ahead on a few slides. So business deposit accounts. So I'm going to talk about, what documents you need to open your account, and also, what services banks provide once you open a deposit account. So you can open a business account once you have necessary documents and they've been filed and you can provide them to the bank. And the types of documents that you will need are going to be somewhat dependent on the type of entity type. So if you have a sole proprietorship, a partnership, joint venture, or corporation, that's going to impact what the bank or the lender asks for. And I'm going to say this multiple times during this presentation: consult with your CPA or your legal counsel on what the best entity type is for you and your business. The bank is not going to determine that for you. That's going to be on you and your advisor to sort of figure out. And so you go to the bank, you want to open up an account. They're going to ask for certain documents. And these documents are really meant to be able to identify who's really involved in the business, because all banks have certain requirements, legal requirements, to be able to say this person owns this account. And so some of the docs they'll ask for are customer due diligence forms, which identify beneficial owners. So think when you think of beneficial owners, think someone who owns maybe 20-25% of the company. It could be a person or an entity. Your valid tax identification number, which is to businesses. It's a social security number for a business essentially. Your corporate and partnership resolutions. Which is just really a framework for how your company is going to make decisions. So, a resolution can set forth who's allowed to open a business account, right? articles of incorporation, and then certificate of good standing, which really tells the bank and whomever actually that you are able to operate your business in the state you're in, and that you're up to date on your registration and registration fees and all those things. So the services a bank will provide, think about it as a bank providing the same services that you would get for your own business account for the most part, checking and savings, checks, online banking, bill pay. I think the two things that are very business specific would be a payroll account. And just to clarify here, the bank does not calculate your payroll. The bank isn't going to tell you you have to pay $100,000 this week for payroll. The payroll account is just an account to hold the funds after you have, or your business has calculated how much payroll will be dispersed to your employees. But there are third-party payroll firms that will do that for you, like ADP and like Paychecks with an X at the end, that will calculate payroll. But when it pertains to a bank, the payroll account is literally just a bank account to hold payroll funds before they're dispersed. And then also there are wires and ACHs. So this is not the entire list, but the main things to expect from a bank in terms of services when you open a deposit account. Okay, so let's move on to business credit. And business, I'm going to say credit and lending and loans, I'm probably going to use those words interchangeably. The key point is you're borrowing money that you got to pay back sometime. So I'm not going to read this sort of table of contents because we'll speak through everything as the presentation progresses. So key differences between personal credit and business credit. So like I mentioned before, like your personal credit is linked to your social security number, but your business credit is linked to a taxpayer identification number, a TIN, or an EIN as we have it, which is an employer identification number, I believe. And, the type of credit you might want to seek will depend on your business structure. And like I said before, speak to like a tax consultant, legal counsel, somebody who can help you out help you figure that out if you're not sure. And one thing to point out, especially when you're an entrepreneur, you're opening a really small business, is lenders will look at your personal credit as well, alongside your business credit. And the idea with that, how do I phrase this? The point of doing that is because if the bank can trust you with your own money, they feel like it's an indicator that it can trust you with their money. And so it's important to be well aware of your personal credit and maintain it when you're applying for business credit, when you're a smaller business. When you're a massive multinational corporation, no one is looking at personal credit of any one individual. But for smaller companies just getting off the ground, personal credit is going to be something that banks and lenders in general look at. So why might you need business credit? Convenience, right? It's a lot more convenient to have funds set aside that aren't coming from your pocket to fund your business. And in terms of credit cards, business credit cards, purchase protection, right? So if you have a dispute with the charge, or you think there's been fraud, that a lot of business credit cards offer fraud prevention or charge disputes. Business credit cards reduce cash flow problems, again, because you have someone else providing capital or money, and you're not using your own money. And because certain types of business credit or loans are used for certain things, it helps you categorize your expenses. So I'm going to use the business credit card example again, right? That's a really easy way to categorize your expenses. some credit cards actually offer you business categorization, but also you can presume that if it's using a business credit card for an expense, it's hopefully for a business expense. You can build customer credit, and I'm going to skip to the last bullet point just to save some time here. Using business credit is a way to pay yourself and invest in your future. And I say that because when you get a loan from someone else or credit from someone else for your business specifically, your funds remain yours. So, as an entrepreneur, you're sort of bootstrapping everything. It's all on you, right? So if you can keep your money, that's great. And you can use it for retirement or investing for you, right? And for your personal future. So those are sort of the key reasons you might need business credit. So when we talk about credit or lending, there are two types of lending when it comes to the assets securing the lending, so to speak. So you have secured lending, which if you think about it, think of a mortgage, right? You get a mortgage loan, and that loan is secured or collateralized by the house, right? So if you don't pay your mortgage for a long period of time and the bank chooses to foreclose, the bank is entitled to take your house to sell to pay back the loan. Same idea here with secured lending, right? There is some asset that is securing the loan in the event that the borrower can't pay. So it could be real estate, depository accounts, equipment, inventory, or accounts receivables, meaning money that your customers owe you. And unsecured lending is highly focused on the borrower's creditworthiness. Unsecured lending is too, but with secured lending is too, but with unsecured lending, there's really a focus on your creditworthiness more so than unsecured lending, because there are no sort of assets that the bank in theory can seize, right? And unsecured loans will typically have higher interest rates, again, because the bank has taken a bit of a higher risk. So the bank or the lender is going to want to be compensated for that, and they do that via higher interest rates. Okay, the types of business loans and lines of credit. So one thing, especially as an entrepreneur starting out, one thing you could do is get a home equity line of credit, and that is essentially the lender is basing the loan and the size of the loan on the equity in your house, right? So equity being the value of the home. So you get the value of your home appraised minus the mortgage, and the difference, assuming it's positive, is equity in your house. And the benefits of this are, lower interest rates. Interest may be tax deductible, but again, talk to your tax consultant. And but the key drawback here is this is your house, right? So you're sort of mixing business and personal here. And so if you do not repay the loan, your home is subject to foreclosure. So that's something to really think about with a home equity line of credit that you're using to fund your business. So vendor credit. So vendor credit you wouldn't get from a bank, you'd get from a vendor, right? And basically, so instead of having to pay cash right away for 1,000 water bottles or whatever you're buying, right? You would make the purchase, receive the goods, and then the lender would give you 30, 60, 45 days, whatever you guys negotiate, to pay back. So you're buying on credit. And it's good for cash flow because you get to preserve cash flow for that period of time that you don't have to pay the lender back. And if you handle the credit with vendor credit well over time, the vendors might increase your credit. And one thing to keep in mind is that some vendor credits don't report to credit agencies, but may provide credit references. But the thing to keep in mind is banks may or may not accept credit references as acceptable credit history for application for a business loan. So just sort of keep that in mind. When you're thinking of business credit, you might want to have other types of credit to build your credit history beyond vendor credit. Business credit cards essentially work the same as your personal credit cards, credit cards that you and I would use. You know, annual fees, interest rates may increase based on late payments, a credit risk, late fees. I mean, very similar to a personal credit card. But, you know, in terms of benefits, right, like I said before, helps you track your expenses, because a lot of credit card companies will categorize your expenses for you, separates your business and personal. And a lot of banks provide points and cash back, which you know is very important and critical when you're starting your business, right? Any additional cash you can get or save is really a bonus. And here with the drawbacks, you know, interest rates might be high, and if you're not cautious and conscious of how you're swiping the card and using it, you could easily get yourself in a lot of debt. So you need to be monitoring your spending pretty actively. So business lines of credit. Business lines of credit are the same things as revolving lines of credit or revolvers. All those terms are used interchangeably. Revolving lines of credit could be secure, but could be unsecured, but sometimes they are secured. And the way it works is pretty similar to a credit card, but much, much larger amounts you can borrow. So for example, if I were to receive a $1 million revolving line of credit, I can borrow up to $1 million and then I can pay it down, right? Maybe I pay it down by $400,000. Then I have $600,000 outstanding that I owe, but I can borrow another $400,000. So with revolving lines of credit, you can borrow up on the line and then pay it down, then borrow some more and pay it down, right? As long as you don't exceed that $1 million or whatever max threshold you have. There might be fees associated with these, annual fees, or some lenders might call them facility fees, renewal fees. The length of the term before you have to pay back the revolving line of credit, 2 to 3 years. Sometimes, you know, I've seen 1 year, you know, sometimes I've seen a little longer. It sort of depends on what you and your bank negotiate, but you're not going to see like 10-year revolving lines of credit. That's just sort of not the nature of a revolving line of credit or a business line of credit. And I reference here that the bank will look at the 5 C's to determine qualification. We'll review that later, but the 5 C's are just sort of key things that it's just like an industry terminology that banks use to determine credit worthiness. And in terms of benefits, again, it's great for cash flow because it's someone else's cash that you're using to fund your business. So you're not solely relying on what you're bringing in as a business. You also have this loan to help fund the business. You only pay interest on the amount that you've borrowed. You don't pay back the loan until the very end, when the loan matures. And the drawback here is that it's not ideal for long-term or large purchases. So if your business wanted to acquire a warehouse, right, you probably would want a loan that's longer term, given the permanency of a warehouse. So you might want like a mortgage that's 30 years, 15 years, right? So a 2 to 3 year business line of credit probably isn't what you would want. And so we're going to go to a business loan, which oftentimes is referred to as a term loan. So it's just one lump sum of money, and you draw on the loan, right? And then you pay, or in other words, amortize the loan on a set schedule. So that could be monthly, quarterly, semi-annually, whatever terms you and your lender negotiate is how you pay back the loan. There may be an application fee. You could get a fixed rate, but you could also get a variable rate. And term loans are good for specific purchases because they can be a bit more longer term. They could be secured or unsecured, like we discussed earlier. And one of the key benefits of a term loan is because there's an exact payment schedule, it helps you with your financial planning and your budgeting because you know how much has to go out each month. With a revolver, you can start and decide on your own how much you want to pay down each month, but the bank isn't necessarily going to require you to pay back your revolver until it's fully due. But whereas with a term loan, there's going to be a set schedule that you have to pay back. So it's a good way to sort of manage your cash outflows. Drawbacks is you pay interest on everything. So you draw, if you have a $2 million term loan, you draw on the charge $2 million, you're paying interest on the charge $2 million. And some lenders will have prepayment penalties. So let's say get a term loan and it's not due until 2026. If you choose to prepay it and pay back the entire balance in 2023, some lenders will charge a prepayment penalty because the idea is the intent was to have like 5 years of interest earned by the lender, but by you prepaying it, they're earning less. So that's sort of where that comes from. And lastly, I want to make a key point here is that the term loan or a business loan, the funds aren't revolving. So once you draw on the term loan, if you pay it down, you can't draw some more like you would with a revolving line of credit. So just keep that in mind. Small business loans SBA loans are backed by the Small Business Administration. When I say backed by it, oftentimes many times SBA is sort of guaranteeing the loan, or a portion of the loans at least, which reduces the risk for the lender. And the loans can be used for a variety of things, like working capital. When I would say working capital, I mean like you funding your business, making purchases for your business, buying equipment for your business to some extent. And you can purchase things like furniture, real estate, machinery, you can use it for construction. Some of the benefits are you get really competitive terms, which makes sense, right? Because the SBA is trying to help smaller businesses. So if you get an SBA loan, your terms are probably going to be much more borrower friendlier than you might find elsewhere. And the SBA makes it easier to qualify. And documents you would need, they're loan specific, but at a minimum, you will likely need 3 years of personal tax returns, 3 years of business tax returns, and 3 years of financial statements like your balance sheet, your profit and loss statements, your accounts payables and accounts receivables, agings, debt schedules, and if you have any real estate, your lender's probably going to want to look at their real estate purchase agreement to sort of understand what cash is expected to leave the business. And then we have microloans, which I believe here again, it's backed by the SBA, and they're much like micro, meaning they're really, really small. So they can be up to $50,000. Average is $13,000. So they're quite small. And you would get these through an intermediary. So you wouldn't necessarily get the money straight from the SBA. SBA would sort of fund this intermediary, and then the intermediary would then give it to you. And so here again, you can use the microloans. Actually, let me just back up for a second. They'll usually require some form of collateral or personal guarantee. Personal guarantee meaning that if the business cannot repay the loan, that you, the individual, are liable to pay the loan. So keep that in mind. And this actually goes for not just microloans, but especially, again, like we're talking about small businesses just starting out. Because again, the lack of the sort of the newness of the business and the size, some lenders, many lenders will oftentimes want a personal guarantee. But back to microloans. So you can use microloans for working capital, inventory, supplies, furniture, fixtures, or equipment. And I know on the prior page, you said that SBA loans you can use to buy real estate. Microloans, which are backed by the SBA, cannot be used to pay off debts or purchase real estate. The max term is 6 years, and interest rates will vary between the lenders. Interest rates are really based on risk. And so, but in general, you're probably going to see perhaps an 8 to 13% interest rate. So then another type of business credit or loan will be a specialized loan, specialized lending. And that just means that the loan is structured for the type of business you're running, or the use of proceeds of the loan. So type of business, insurance professionals, veterinary professionals, franchise owners. There are loans that take into account the risk of the business, the cash flow those businesses generate, and the loans are structured for those specific types of businesses. Equipment loans, that's going to be a loan that is structured based on the use of the loan, right? So if you're buying equipment, the loan will be structured to facilitate that. And with the equipment loan, it's most likely that the equipment will be collateral for the loans, which essentially means if the business can't pay back the loan, the equipment, the bank will seize the equipment and sell it essentially as a secondary source of payment. But these are just a few types of specialized lending. I would highly suggest when you're seeking out any business credit, if you have a specific purpose for the credit, perhaps it's a good idea to bring up specialized lending with your bank or lender. So we just talked about a bunch of different types of loans. Probably went through pretty quickly, but one thing to keep in mind when you are seeking business credit is predatory lending. So there are laws that are meant to prohibit this. I take training on this every year, right? Banks and the government and the regulators are pretty serious about preventing predatory lending. And by predatory lending, I just really mean sort of charges or fees or terms and conditions that are just so unreasonable and out of whack given what you're seeking. So banks, and also, I think things like hidden fees can be considered predatory lending. So banks have to disclose all the charges that you can expect, that you should expect. They have to disclose the amount financed, APR, annual percentage rate, total payments. And so not to I don't want to sort of read every bullet point, but I think key here is to really ask questions, right? If something seems off, ask about it and shop around, right? You might not know that the terms you're getting are unfair, and that's not necessarily even predatory, right? You could get a bank could charge you a higher rate than another bank based on their assessment of risk, and it's not predatory. It's just sort of their assessment of risk. But just in general, make sure you ask around, make sure you ask questions and shop around, right? If you can get multiple quotes, do that. Kind of like, like keep going back to the mortgage thing, right? If you can get a better rate from bank A than bank Y, do that. And so I just sort of went through a lot. And you're probably wondering, okay, so where do I start? What questions do I ask? So good place to start is to understand the fees, right? Because you want to know how much money you're getting debt, you're getting money that you get to pay back, but that's going to come at a cost, right? So you want to understand what fees are involved. Application fees, are there annual fees, are there service fees, are there late fees, right? Prepayment penalty we talked about before. Is that a deal breaker for you? If you have plans to prepay the debt, you might not want a loan with a prepayment penalty. Understanding your interest rate, is it fixed or is it variable, right? And if it is variable, that means it can go up, it can go down. And you want to know, if it is variable, is there a cap, a ceiling, beyond which it won't go up? When does interest start accruing? What are the payment terms or the minimum payments? When do you have to make payments? How often? How do you access your money? Who do you contact if you have any questions? And I think my advice would be just ask any and all questions you have. Debt is a very helpful tool in terms of growing your business, but you have to pay it back, and and it impacts your business credit. So you want to make sure you understand how to use it, and use it well. And a lot of the questions I list here in terms of fees and interest rates and like minimum payments, you can negotiate, right? And I encourage you to really stick up for yourself and put your best foot forward. We'll talk about that probably in a slide or two. But if you don't like the terms you're given, try to negotiate, right? And so these questions are questions that you should start to ask. And if you're getting answers you don't love, try to negotiate or try to shop around. So how do I get credit? And so, as I mentioned earlier, banks will look at like the 5 C's, right? And so capacity, capital, collateral, conditions, and character. And we're just going to go through each of them here. So capacity is your ability to repay the loan. And some of the questions that the lender is going to know is, how long have you been in business, right? So if you've been in business for 5 years, then that you've sort of proven that you can operate for a good amount of time. And so that might mean that you are able to generate revenue going forward and cash flow going forward, which could imply that you can pay the loan, right? And another question they're going to ask is, how much do you make each month? What are your expenses? Because again, that speaks to cash flow, and cash flow is going to be how you pay back the loan. And the bank will look at your business plan to ensure that you've included steps you would take to repay the loan. And then the second C is capital. And it's the question, the capital meaning like money, right? Like how much, where is the capital in the business coming from, right? Because the bank is not going to fund every single dollar your business spends, right? It's going to be a portion of it, right? But it's not going to be every single dollar. And so the bank is going to want to know, how much money do you have in the business? How much money do other investors have in the business? And so that's where the whole capital pillar comes from. And then collateral. So as I mentioned a little bit earlier, collateral is a secondary source of repayment. So in the event that for some reason the business can't pay back the loan, the bank has some recourse in order to get its money back, right? So the bank might ask, what types of equipment does the business have? Types of inventory, types of vehicles. Do you guys own real estate, right? What about your accounts receivables? Because all these things, right, are essentially assets of the business that, if needed, the bank will seize and sell. Hopefully won't come to that, but that's just the truth about collateral. And one thing to keep in mind is if the bank is going to take any form of collateral, what will happen is that they will likely file a lien. And this isn't a tax lien where you get in trouble given paid your taxes. Usually the lien will be filed at the same time you're getting the loan, right? At the time you're signing your loan agreement. And all it really is telling anybody else that the lender or the bank has a lien on this. So if you also want to get a lien on that asset, you have to come behind us, right? You're secondary. And so the lien is what legally allows a bank to seize the collateral. And then conditions. So think of conditions in terms of what's going on in the broader market, in the broader economy, in your industry. So the bank's gonna ask questions like, is there a market for your product, right? Because it's not enough to say, this product I really believe in. The bank also has to believe that people are gonna buy this product, right? Because again, the bank is thinking, how's this loan gonna be repaid? And it's gonna be repaid if it's gonna generate cash flow. It's gonna generate cash flow by selling something. And so we wanna make sure that you can actually sell something. There's a market for what you're selling. We're also gonna ask, what are you using the line for, or the loan for? And we're also gonna ask about projections of future growth, right? Because while we might underwrite to your historical statements, we also want to know what to expect, right? And the bank or the lender will ask questions about your projections, right? If you plan on growing from like 100,000 business to a 200 million business in like 2 years, maybe that's true, but the bank is going to have a lot of questions as to the validity of those projections, and really want to underwrite and make sure that the projections are valid. Bank is going to want to look for sustainability and growth. Banks don't want to understand what's going on in the broader economy, right? So if you are in a space that's in a downturn, how is that going to impact your business? And then lastly, even in my work, right, and what I do when I'm lending to startups, sometimes it's a plus if the CEO, the founder, or the CFO, or someone really in charge of running that business has experience in the industry and has proven that they can be successful in this industry, because it gives the lender comfort that you know what you're doing and you have experience, and you've been able to navigate the pitfalls in the industry before, and so hopefully you can do that again. So character, this is really just about who you are. Similar to what I said before, it's like, how long have you been in the business? What's your reputation in the industry? If you've been in the industry enough to develop a reputation, what's your educational background? And that's more so to understand, like, do you have, is there other experiences, or is there training that is very much applicable to the space? It's not saying that you need a certain educational background or degree to get a loan. It's just help the bank understand how much knowledge is in the business pertaining to this particular field, right? What about your personal credit? And like I said before, right, especially when you're starting out, small business, getting like a small loan, the bank's going to want to understand your personal credit history, because that might indicate how you manage their money. Again, are there any outstanding judgment, liens, tax liens, unpaid child or spousal support? And like I said, the last bullet, right? That's repeating what I said before. Generally, how a person handles their own credit tells a lot about how they will handle their business credit. And then, so those are the 5 C's. And then, so, all right, you've heard about the different lines of credit, heard about the 5 C's. Now the question is, how do I make myself a good investment for a lender? Or in other words, how do I make myself an ideal candidate for a loan? So first, personal credit. Make sure you get your credit report, review regularly, just dispute discrepancies. You can get a free credit report every year. And make sure you take good care of your credit. Pay, like the last bullet says, pay on time, all the time, and use credit responsibly. And just to continue the whole idea of how do you make it a good investment for a lender, make sure you have all your local licenses, make sure your entity is registered as it should be. And if you need to work with professionals to ensure that you are following all the necessary regulations and laws in your industry and in your state or your jurisdiction, in terms of the legal structure for your business, like I said before, talk to your tax consultant or an attorney. The bank is not going to tell you what kind of business you have, what kind of entity you have. That's on you to decide. And that decision is probably going to have to take into account tax consequences. So just talk to a consultant or an attorney if you were able to. Understand that costs money, but if you're able to, definitely do that. And then, understand your business, develop your brand, do research in your market, prepare a business plan. And perhaps the University of Maryland offers classes, but I know that there are definitely classes offered by institutions on how to create a business plan. Track your business and personal credit expense. Track your business and personal expenses separately. Use separate checking accounts. Try to avoid commingling funds. This just helps you sort of create cleaner records that you can give to the bank. Again, establish good credit with suppliers and vendors. If you open a business credit card, that also helps you establish credit. If you also want to get a loan, a business credit card might be a good place to start. And then, take advantage of classes and workshops like these to stay relevant in your industry and sort of laws and regulations and just like how to sort of navigate the world as a small business. And then for loans and lines of credit specifically, make sure you have 3 years of personal tax returns and 3 years of financial statements. I just want to sort of clarify here, and just this applies to basically everything I've said. Each lender is going to have their own processes. I mean, this is just what I'm speaking here about is what, I and my colleagues who have decades of experience have sort of learned and understood. But each lender will have their own requirements. Many of them will be the same across lenders, but each lender is going to view you differently, right? So this is just sort of like a very good starting point, but make sure you understand your lender's requirements. So 3 years of personal tax returns, 3 years of financial statements, and lenders, depending on what type of loan you're looking for, they might require more documentation. And just a quick word about tax reporting. So I know sometimes one might have deductions, right, and write-offs that reduce your tax liability, and they do that by reducing your bottom line, right? That you have to report to the IRS. Keep in mind that if a lender seeks those tax returns and asks for them, they're going to base the amount they might base the amount they want to lend you on what they see on the tax return. So if the bottom line is this kind of small number, that might impact how much you can borrow. But that being said, like I've said probably a million times already, talk to your tax professional and understand how your tax strategy might impact your ability to borrow. And then this is a disclaimer. It's not a commitment to lend, guys. This is just a very informational discussion. So that is it. I don't know if you guys have any questions. I can't see the chat. I don't know if any questions came through or not, but I'm going to stop sharing my screen here.
Thank Thank you so much. That was very informative, and I hope very helpful for those who have been listening. So I don't see any questions. So if anybody has any questions, you can at this point either submit them via chat or Q&A function, or you can also raise your hand virtually. There's a button to raise your hand, and I can unmute your microphone so you can ask your question that way.
I think I see something in the chat. Yeah, I think this question is, will I make my slides available? Yeah, I think Ala will send the participants or the attendees the slides.
Yeah, I'll follow up with slides. We're not sure yet if we will be able to post the video yet, but if we get the permission, we will also post the video so you can rewatch it again.
Yeah,
but that's still to be determined.
And I know there is like a lot in here. So when you get the slides, my contact information is there. So like, please don't hesitate to reach out if you have any questions. Would love to be of help. So.
Yeah, thank you so much. So you're a rock star.
Thanks, Anita. Thank you. I see that from Sandra Lee. So I think that sort of depends, right? So if you don't have business tax returns, then you probably would need personal, but that is going to be very dependent. So let me rephrase. Let me state the question for everyone. The question is, did you need 3 years of tax statements for a startup? Would this be just personal tax returns? So the answer is it depends, right? Like I gave us sort of like a blanket disclaimer. Each bank is going to have their own requirements, but I worked with some of my colleagues on this, and one of the things they said is very typical in their experience is 3 years of personal and business tax returns. Now, if you're just starting out your business and you don't have 3 years of tax returns, maybe 3 years of personal returns will suffice. It's just a very specific discussion that you should have with your lender. And again, small business lenders have a lot of experience with people who've been in business for different lengths of time. So I'm sure that there are other documents, other ways you can underwrite and determine creditworthiness if you don't have enough tax returns. I'm not sure if that's helpful or not. But.
Yeah, thank you. We have another question. Do you recommend a startup going to a CPA before pursuing any sort of loan other than maybe a business credit card?
I think if a CPA has worked a lot with helping clients borrow money, that could probably be helpful. I think and also the CPA might help you understand how your tax returns might impact your ability to borrow, especially if a bank is going to ask for your tax returns. So it might be helpful. I would just say, make sure the CPA can answer the questions that you have. I wouldn't just go to any sort of CPA. Make sure you go to one who's going to understand and be able to answer your questions about lending. Because that's money that you have to pay them, so make sure that you're going to answer your questions.
I have a follow-up question too. So you talked about different terms. You also talked about predatory lending. How somebody who's not experienced and hasn't done that before, and they're looking at a set of terms, how would they know if those are good or not good terms? It's a tricky question, I know.
Yeah. That's a good question, right? That's a question we quite frankly should all ask ourselves personally in terms of business. So I think one thing you could do, and one thing you should do, is get different quotes, right? Because lending decisions are based on creditworthiness, right? And it's based on a lender's assessment of risk. right? So how much they're willing to lend and the fees they're willing to charge and the interest rate, that is all based on their assessment of risk. And different lenders might have different assessments, right? So a good way to determine whether someone's fees or terms and conditions are just out of whack with what we should expect is to get more than one quote. Because you're right, it's sort of, it's hard to know if it's predatory lending if you sort of have no experience. Like, and I kept going back to the mortgage thing, right? I bought a house a year ago. I asked different people, asked different banks what their rates were going to be, right? Because I didn't have like a benchmark, right? And that's how I sort of knew like how to move. So to be more concise, I would get different quotes, and if you have a network of other entrepreneurs who've been borrowers, I would ask. But also, like I said, right, I have to take training every single year of predatory lending, and most banks do. Banks are regulated, so I would suggest that you go with a lender that you feel is under who's under certain sort of regulations and who you feel is reputable, right? So a Pacific Western Bank or Wells Fargo is probably, not so probably, but might be more reputable than a lender that you've never heard of. So just to be concise, shop around and seek reputable lenders, and then ask your network, right? Like, say, I'm getting these terms, do these sound right to you?
Well, thank you so much. That has been fantastic. So does anybody else have a question that they would like to ask, either by chat, Q&A, or raise their hand? Well, if not, then thank you so much. We will share the PowerPoint presentation by email. And if we can, then we will post the video on our Startup UMD YouTube channel sometime probably next week or so. So stay tuned. Thank you so much. I'd like to thank Tolu for sharing your time and your wisdom with us today. Thank you so much. It's been incredible.
Thank you, guys. All right, have a great weekend and a great day.
Thank you.
Bye.
Bye.